Fargo actually is buying in a lot of shares, and you can argue that they're improving the per share value because they had this bad news. They're buying it cheaper. But I think 10 years from now, I think if you look at the 10-year record of Wells Fargo 10 years from now, you're very likely to find that it outperforms most of its competitors.
Would you be buying more shares now if you could? You can't because of the bank thresholds.
Yeah, if I don't want to give recommendations on which stocks to buy.
To Andrew's other point, though, I think you touched on it very quickly, but the idea of being ruthless, if you lose a shred of reputation for the company.
That's Berkshire.
Right, but what you're saying, you're distinguishing between Berkshire-owned companies and investments.
Sure.
It may be worth pointing out that you're a passive investor in Wells Fargo and the bank, and you have to be.
Yeah, well, I have to be a passive investor.
But I'm not sure everyone understands that.
No. We do not want to be a bank holding company. We can become a bank holding company if we own over 10%, and there's a point at which your activities could make you or something. So we owned a bank, and we had to dispose of it back in 1980. We bought a bank, and then they passed the Banking Act of 1969. We'd have bought more banks, actually. I like the banking business. And then they changed the law in 1969, and we had 10 years to divest. Maybe they changed it in 1970. We had 10 years to divest of the bank we owned. But I would not. We'd still own that bank, and we'd own other banks if they hadn't changed the law in the 1970 period.
Okay. Folks,
but I don't feel responsible. If you're having trouble with your Apple phone, don't blame me.
Okay, we have much more from Warren Buffett still to come. Chairman at NBC Universal, access to 25 years of annual meetings. This is stuff that only Berkshire's been holding on to for this time.
Yeah, Steve had suggested it to me a few times, and then he suggested it a little stronger, and it sounded like a good idea. I didn't think it could be done like this, so we just gave him all the annual meeting material. We didn't give the movie because that's got some stuff that we promised not to put out.
You mean with celebrities who have done
the celebrities come on, yeah. But in terms of the annual meeting stuff, door to portal to portal, and everything we had, and even with university students or anything we had, we gave Steve. And I told Steve, you can do with it exactly what you want. I mean, I've known Steve a long time, and I thought it'd be an impossible job, but I knew that if it was done, it would be done well. And it blew my mind when I saw it.
I mean, it's been really useful through the cash hoard that Berkshire has. At the end of the year, you had $116 billion in cash. You told us last week that you had spent about $12 to $13 billion in the first quarter. So you were thinking the cash hoard was closer to $100 billion based on some other things that you had potentially bought as well. Okay, so you're spending billions of dollars, but you still have $100 billion. Is that ideal?
No. We earn very little on it, but that is, we will earn a little more this year on it than but it's just about the world's worst investment, except doing something dumb that you're doing for a longer term. But it does give you the ability to move very quickly if something very big comes along. But I would much rather have that number be 30 billion than 100 billion, and have the other 70 billion invested in, ideally, in businesses we own, but also in securities we own. And we did, for example, put out, I don't know whether it was 12, how much was in the first quarter and how much was in April, I'm not sure. But we put out 15 or so billion net into stocks, and I like that. And it wouldn't, if I could find them and buy them in sufficient quantity, if that had been 50 billion, I'd have been even happier in the first quarter, or if we'd bought a $50 billion business. But you don't want to let money burn a hole in your pockets either. I mean, if we buy a business, we buy it to keep. So if we pay X for a business or 2X for a business, the business doesn't know. It doesn't adapt itself to what I pay. It's going to earn the same. And so if I make a mistake on purchase price, Berkshire Hathaway lives with that mistake forever.
For the rest of us who see you sitting on $100 billion, we think that you think the market looks expensive and that you can't find anything that's worth putting your money into that makes it better than cash or short-term treasuries?
We own $170 billion worth of equities. We go up every quarter, and we went up a fair amount in the first quarter. No, I would rather own the $170 billion of stocks we have than own treasury bills by a very significant margin. But there are limits to how much I can buy of some of these companies that I like. Usually we quit at 10% almost always. Now, if you told me I had a choice and I couldn't make a change, if you told me I had a choice of owning treasury bills, long-term treasuries, or common equities, I'd buy common equity, and I was going to keep it for 10 years or 20 years, I'd do it in a second. And we'll get the money employed. Something will happen.
Something will happen, meaning a big deal?
It could, yeah, sure. I could spend it all tomorrow. I mean, I wouldn't spend the whole 100, but although if $100 billion deal came along that Charlie and I really liked, we'd get it done.
You get it done by spending it all or by financing part of it?
Well, we'd probably we might borrow 25 or 30, or we might sell some things. I mean, but one way or another, we'd get it done if we liked the deal.
There are questions that came in from shareholders that I got this weekend, and I didn't get a chance to ask you all the questions that came in. Some of them said, is $20 billion still the amount that you feel comfortable holding? Others asked, if you've got all this and you're telling all of us to put our money in an S&P index, why don't you put that $100 billion in an S&P index?
That wouldn't be the dumbest thing in the world if we did, but that's a lot to move in and out. No index fund would take it, I mean, to start with, knowing that we might want to yank it out, 50 billion of it out in a week. So we'd almost have to create our own index fund to do it.
It wouldn't be hard.
Well, it'd be a fair amount. I mean, they're better set up to do it than we are to buy 500 stocks in the proper proportions and keep it indexed. But we could create something that was a quasi-index fund, and that would have been smarter than what we've done, Becky. That was smarter. You know, I mean, I've thought about that some. I think it's a little harder to act when you see something later on if you do have to unwind 500 positions and all. I like to move when I move. But net, if you told me over the next 30 years that Berkshire would keep its excess funds, we'd still have 20 billion at least in treasuries, or treasury bills. But if you told me we were going to follow, for the excess money, we were going to follow an index fund policy versus a treasury bill policy, I would say the index fund policy would work well, assuming we could execute it reasonably well.
Okay. Let's talk about Apple, the place where you were spending the bulk of that cash that you were in the first quarter, where you were deploying it. $12 to $13 billion that you put in. That's on top of the, I think, $27 or $28 billion you already, maybe it was $29 billion you already owned in Apple as of the end of the year.
Yeah.
That's a big chunk of that $170 billion. It's the biggest stock that you own by far. It already was before you bought these additional shares, 75 million shares. Why?
Well, I should say, in the past, we've had plenty of times when a single stock was a bigger proportion of our total net worth. But in terms of recent times, well, it was a company I liked, a business I liked very much, and we could buy a lot of it. There's some others that are much smaller companies. We just can't buy that much. I might like them equally as well, but I can't put as much money in it. But I clearly like Apple, and we buy them to hold, and we bought about 5% of the company, and I'd love to own 100% of it. But that's the test. Would you like to own 100% of a company? If you're going to buy 5% of it, we're not buying a stock when we buy Apple in our minds. We're buying 5% of a business. We buy 100% of some businesses, and when they're publicly held, we buy 5%. But we bring the same thinking to it, and we like very much the economics of their activities, and we like very much the management and the way they think and the way they act. Out of bankruptcy, having a one-for-one offering, and then 2 years later, in 2008, when the crisis hit and also hit housing, the company found itself needing money again, and we put up 300 of the $400 million they needed at that time, and 18 years from the time we bought the first stock, and 12 years from the time we, in effect, bankrolled the company in terms of coming out of bankruptcy, we've never received a dividend, and the stock that we backstopped in 2006 at $40 has been selling for less than that. And in general, the earnings estimates, the new products and that sort of thing, falling short. Now that happens with companies we own too. I mean, the business can be tough, but when they received an offer from another company that also had been an 18-year-old shareholder and perfectly responsible building materials company that actually competes with our company, Johns Manville, this country, they made an offer, and the company did not. We own 30% of USG. The company did not call and say, "What do you think of this offer?" or anything of the sort. They just called afterwards and said that their board had unanimously decided that it wasn't in our interest to negotiate with them or anything. And like I say, we own 30% of the company. And then the company made a second offer, and the German company, Knauf. And again, they were turned down with no negotiation or anything of the sort. So we really felt the directors, who are probably very fine people, I don't know them, but we felt that they did not represent our interest, and that and we said that we intended to vote against them at the annual meeting. We don't have a candidate of our own or anything like that, but we just think that directors are there to represent shareholders, and we did not feel they were certainly representing us with a 30% interest. Since then, the two proxy advising organizations, ISS and Glass-Lewis, have said that they think they recommend a vote against these directors as well. And now the company has said it's going to negotiate with Knauf. So that is a situation. That's the first time, I think, in the 53 years I've been in Berkshire, that we've voted against a slate. We withheld our vote at Coca-Cola a few years ago because of a compensation plan, and we voted a time or two against individual issues, maybe on stock options or something of the sort. But it's a question of whether the stockholders should determine what they think the value of the company is. All I know is that for 18 years it has not worked out that well, and management has been more optimistic than subsequent events delivered, and we thought they should sit down and negotiate.
Warren, another question that came up from a lot of shareholders, we covered it some in the question and answers period on Saturday, but I thought maybe you could go into a little more detail on it. Just the idea of consumer packaged goods. Companies like Coca-Cola, which hit a 52-week low last month, even though the company came in with better than expected earnings on issues. And a company like Kraft Heinz, which is down about 35% over the last 12 months versus the S&P being up 11%. It has a lot of people thinking that consumer packaged goods don't have as bright of a future.
Yeah.
I think George Paulo may have even called them, saying jokingly that he felt like a dinosaur at the Milken conference recently. What do you think when you look at these areas?
They're still very good businesses. I mean, if you've got a brand, if you look at the return on tangible assets, Coca-Cola or Kraft Heinz or anything, you've got a very good business. It doesn't look as good as it did 5 or 10 years ago. In other words, there's two reasons, I think, for that. One is people seem to me to be a little more willing to experiment with different diets or foods than they were 5 or 10 years ago.
Some people would say healthy diets, where they won't eat things that are packaged. They think that's bad for them. It's a millennial attitude, too.
Yeah,
they won't buy some of the old brands.
Certainly, that's a factor. I think it can be on millennials to some degree. People are more, they've gotten used to more change in their life generally. And so I would say that the that there's still a huge loyalty factor, and but it is not as strong as it was 5 or 10 or 20 years ago. And secondly, there's always been a struggle between the retailer and the brands. I mean, you can't. I mean, that's built into the American market system, and I would say that the retailers, and they've always had private label brands. In some other countries, private label has been much stronger than the United States, for example. And the private label brands are priced below the big brands. And the retailer, every time a retailer meets up with a packaged goods salesperson, they're arguing for lower prices and better deals. And I would say that their hand becomes stronger as the Costco's and the Walmarts and in other countries, as they become stronger, the struggle can tilt a little bit one way or the other. I think a few years ago, I think Costco dropped Coca-Cola, and that's a real test if you want to. And of course, Sam's Club at that time started pouring it on with more Coke and everything, and that Coca-Cola's a pretty strong brand, so that Costco could decide to do that. But if Costco decided to drop a bunch of other brands that you could name, or Walmart decided to drop them. I mean, the packaged good company might feel it more than the retailer would feel it, and they would come to terms faster. It's an interesting dynamic, and it's gone somewhat against the packaged good companies. They're still good, very, very good businesses.
Is that dynamic between the retailer and the packaged goods companies, is that a pendulum swing that swings back,
or is this
a new?
No, and not necessarily. No, I mean, you've got these German discounters coming over here now, and each company's got some muscle. And if you've been selling, whether it's Coca-Cola or whatever food you may have eaten as a kid or something like that, I mean, you're pounding. You want the consumer, because you got to win with the consumer in the end. You've got to have a product that's strong enough that the retailer has to carry it to some degree, and where their private label, even though it's priced below it, does not draw volume away. And if you take Heinz ketchup, it's very, very, very hard to take share away from Heinz ketchup. It's hard to take share away from Philadelphia cream cheese, but I could name some other products which won't, where it's easier to take share away. And the consumer the consumer votes every day, and some things are affecting the consumer, like the feeling that other things are healthier or something of the sort. Price affects the consumer, but just the prevalence of strength of the retailer can affect the consumer too.
Is that why there's so much pressure for some of these packaged goods companies to get bigger, or for new deals to come in? Like, I'm going to take and wrap up with a lot of products, and then I have more heft against the retailers if they try and jerk me around with
you
their
don't get
brands.
if Coca-Cola were to buy, they've got the world's greatest distribution system, so they can push liquids through that. I don't know whether they could push cream of wheat, or something through their distribution system. Obviously, a great distribution system is worth an enormous amount, and like I say, Coca-Cola has a great one. And Coca-Cola, incidentally, they're selling 5% more liquids. They are selling 100 ounces of liquids per capita in the whole world. 7 billion people are drinking a Coca-Cola product, and they're drinking at the rate of 100 ounces a year. That's substantial. Leaves a lot of ounces to go, but they are selling more ounces of liquid. They've got more brands now, but they are selling than they've ever sold, and it grows year by year, and it's growing. And James Quincy is doing a sensational job on that. And first quarter he even showed it. But if you've got a brand that's kind of lost out there or something of the sort, it's hard to get shelf space, and the retailer is going to stock what will move, and sometimes that involves price. But what you want to have is a product the retailer has to have.
Mm-hmm. There are a lot of subjects that drew some controversy and got a lot of headlines from this weekend, including some back and forth between you and Charlie and then Elon Musk. And we're going to talk about that in just a moment, but I think we need to take a break. So, Joe and Andrew, we will send it back to you in the studio, and we'll have more on that coming up in just a moment.
That'll be here.
There are so many things that we wanted to talk to you about this morning. One I've kind of been holding off, waiting to get your comments on, is Elon Musk. Elon Musk was brought into the conversation this weekend at the shareholders meeting by a question. I forget who asked it, one of the shareholders maybe, bringing up this idea, or maybe it was Andrew. Somebody brought up this idea of moats, competitive advantages and moats. Elon Musk recently said that he thinks moats are stupid.
I wish he'd give me his.
And that became a subject where Charlie weighed in and said, yes, he's right that actual moats around castles are stupid. But you guys got into a little bit where you were joking around, saying that you'd like to see him try and get into a candy store. He responded this weekend with some tweets saying, I'm starting a candy company and it's going to be amazing. I am super, super serious. It just occurred to me that the plot of Willy Wonka is really messed up. Okay, just for the sake of argument, what do you wish for in candy? Crypto candy. Then I'm going to build a moat and fill it with candy. Warren B. will not be able to resist investing. Berkshire Hathaway, kryptonite, I'm killing me, LOL. What do you think about all of this?
Well, if you look at the leading candy bars, for example, for the last 50 years, I think you'll find Snickers on top, and then you got M&Ms. You got two types, so they don't combine the peanuts with the other ones. But I think they're number 2 and 4, and Hershey's in there number 3 or something of the sort. Yeah, I can't take them on. I don't think Elon should take them on. They have moats. When you go into a drugstore, 7-Eleven or something, and you say, I would like a Snickers bar, and the owner says, oh, I've got something. The Musk bar at 10 cents off the Snickers bar. You say, give me the Snickers. And if he doesn't give you the Snickers, you go across the street and buy the Snickers. The brands are moats, I mean, obviously. And if you try to, this product is selling, to hundreds of millions of people who want Coca-Cola. If you say, I'll sell you something for 2 cents less, or I've got some celebrity's name on it. They actually, Richard Branson tried Virgin Cola in the United States about 15 or 20 years ago, and a million others have been tried. So I don't really have the same urge to produce automobiles that he apparently has to produce candy, but I don't suggest that he take on Snickers.
You're taking me literally and stepping away from the real story here, which is kind of this war of words between you and Charlie and Elon. And I just want, do you even know Elon Musk?
I've never said anything negative about Elon. I mean, you're baiting me a little bit to do it. But,
I am.
But I've never, people like his car and everything. But somebody mentioned that now he's talking about financing. Something this morning about that. I thought I heard that earlier.
Yes, well, actually, Andrew just read some headlines where it looked like Tesla may be going back to market to pick up some additional financing. I'm not entirely sure.
Well,
all I heard was the headline.
That's what I call a counter-revelation. I mean, Charlie, because I think it was just a few days ago they said they wouldn't need financing. But he's trying something to improve a product, and I salute him for that. And the American public will decide whether it's a success, and it's not easy. It's probably easier to develop a new car than to compete with Snickers. But some products have terrific moats. Probably Elmer's glue does. WD-40. I mean, there's just certain things that you are not much inclined to be dissatisfied with and see. And I would say that, incidentally, that the iPhone. Has a terrific moat. I mean, people that have an iPhone, or maybe have some other phone, but they want to continue with the product that they've got. They want the new version. It's just easier for them. They've learned how to do everything, and their life's built around it and all of that. And moats are very useful. Costco has a moat in people's mind. I mean, Amazon can raise the price of Prime, 20%, and you can't do that unless you've built something within that image of the Amazon Prime that's based on reality, that you're going to get a lot for your money and you're going to want to use it, and then you can raise prices $20. But if you're selling, some commodity product, you can't do that. You need a moat.
You mentioned Amazon, so let's talk about that, because you did say over the weekend that Amazon is one of the shares that you haven't bought that you wished you had. Are you ever going to buy shares of Amazon?
It'll probably be tough. I probably got so many psychological problems with the fact I didn't do it. It's very hard to do it. I always, when I first met Jeff, I knew he was an incredible person. And he still encloses his 1997 annual report, which I read at the time, with his current annual report. And he's an extraordinarily clear thinker as well as being a brilliant thinker. And then he can execute. I mean, it's far surpassed anything I would have dreamt could have been done. Because if I had dreamt it, if I really felt it could have been done, I should have bought it then. I knew he would do the most with whatever idea he had. I had no idea that it had this potential. I blew it.
Another stock that you mentioned over the weekend saying you should have known it early on was Google, Alphabet, the parent company of Google, because you knew how much they could charge you when it came to Geico.
Yeah, here we were at Geico paying them $10 or something for every click. I mean, $10, and no cost of goods sold. I mean, and it produced results for us. That's why we paid them the money. So I had seen the product work. And I knew the kind of margins. I mean, I always said it's great to find something that costs a penny and sells for $1 and is habit forming. This doesn't cost anything, and it's very useful. I mean, if you're looking up auto insurance on Geico, you've got an interest in auto insurance. I mean, it's a very directed way of talking to people. So the real question in my mind, I'd seen Alta Vista before. I used to play bridge on Alta Vista, and what I didn't know was whether there'd be more entrants. I didn't know enough about technology to know whether this really was the one that would stop the competitive race and all that. But I should have done Google too.
You say that Silicon Valley and a lot of the things that happen there, it's not really your field of expertise, but you've been around and you've seen how a lot of things happen, particularly with how Washington can have an impact. The reason shares of Apple were down earlier this year was in part because of the iPhone, but probably also in part because the FANG stocks overall were under pressure because of Facebook, the trouble it got into, the potential for regulators coming into this arena. What do you think broadly about some of these regulatory issues, some of these privacy issues, or do you even consider it?
Well, I think about that. But basically, I like good news that isn't or bad news that isn't going to last. And I'm saying that as one of them. But I mean, bad headlines just don't bother me. I mean, I had bad headlines when I bought that stock right after 2 or 3 months after Pearl Harbor, and you're going to have bad headlines for a long time. So I am not worried about. We've made the most money when there's been some temporary bad news. I mean, over time. Now, you got to be sure it isn't permanent or something of the sort. But if people get excessively worried about people changing their tastes and what they drink, they're going to drink 64 ounces of something or other, and carbonated soft drinks have lost share. They gain share just steadily for I don't know how many years, practically forever. But then. But bad news does not scare me.
Just to put a finer point on that, though, the regulatory issues concerning the FANG stocks, you think that's just a temporary headline where maybe there's much ado about nothing here? Or you're
the
not
regulatory
sure?
issues on which?
On Facebook.
No, I think that's it. No, that's important. That's important. I mean, if you, 60 Minutes had 2 different ones. They had one back on October 8th, and then they had one a couple of weeks ago that illustrated the effect of, the fellow said Facebook won the election for Trump. The fellow that managed their operation in the last election out of San Antonio and has been appointed the head of their committee and for 2020. And it's a very interesting episode. I mean, they really knew how to target everybody in the country, basically, with things that would appeal directly to them. And that could not only affect them in encouraging the followers to come out, bring out the vote, but it could suppress votes. And I mean, they had Facebook embedded. The fellow used the term embedded there. I mean, so it's a very, very important issue, and I think probably Congress has just begun to scratch the surface of it.
What's different with what the Trump campaign did than what the Obama campaign did 4 years earlier, where they were using Facebook and were kind of seen as like these technology wizards for figuring it out?
Well, they took a first step, and then I don't blame anybody for doing it, but my guess is they thought they were doing it as well in the Democratic campaign in 2016 as the Republicans were, but the Republicans were technologically
advanced.
Yeah, and Obama was advanced for 2012. I mean, the trick is to convince people, but the trick also is to get your vote out, and then the trick, which is really tricky and is very counter-democratic, is to suppress the other guy's vote.
And you think that's the type of thing that will get regulators' attention, or will make Congress pay more attention?
A lot of things in privacy will get it. People impersonate me,
Yeah, Joe does it very well.
Well, he's doing it to a very sophisticated audience in your case. But if somebody impersonates me on some website and says something I say, I mean, it can be all over the world, and it isn't me. This has brought a lot of new issues that are important issues out, and we're just in the early stages.
Our special guest this morning is Berkshire Hathaway's chairman and CEO, Warren Buffett. And Warren, so many things that we've talked about this morning and over the weekend. One issue is just the economy. And I know you told us last week a little bit about it, that it does feel like things have improved a little bit, things have picked up steam. I just wonder why you think that, what numbers you see, what are the things that kind of run through your head in determining the Berkshire Economic Index?
Yeah, I see a lot of numbers, and I get them pretty fast. I mean, and business is generally pretty strong. I mean, you could look at railroad car. Anybody can look at railroad car loadings, for example, every week. They come out on Wednesday, and you can see them by category, 22 different categories. And I think Matt Rose may have mentioned the other day that 18 of the 22 are up, and overall they're up, and they're carrying stuff because people are buying stuff or adding inventory, and you see it, and you're seeing some inflation connect with some of this, but you see it in some building materials. We've seen it particularly in electronic components. We have an operation most people probably don't even know anything about called TTI, and it carries close to 1 million different types of electronic components. You can order any one of 1 million items from us. They're very small, but people buy them because they're using them, and we have a hard time filling orders and in that business, and that's kept getting stronger now for a year, right up to when we're talking here. So we're seeing pretty good business most places.
The jobs number on Friday had some people speculating that we can't get much lower in terms of an unemployment rate, that it's hard to find bodies to fill the jobs that are opening. Do you experience that?
Well, that's absolutely true. I mean, we have a lot of jobs. We have, if you would want to be a carpet installer, you can make very good money, and because there's a shortage of people that know how to install carpet, and we can teach you to do it. It takes a little while, but that's a very good job. And our home builders, and you've read about this elsewhere, but we have, in addition to having a manufactured housing operation, we have a site build operation, as they call them, and we're in Denver and Austin, Texas, various places, and we have a hard time getting people for certain of the construction trades. And again, we're actually funding a school in Denver. We probably have other participants doing it just to teach people jobs that can pay them $50,000 or $60,000 a year. And now there's employment is tight in some areas. There's no question about it.
What do? Do you end up having to pay more than $50,000 or $60,000 a year? Just trying to find out how inflation gets started.
The market system, in the end, if a resource is scarce, whether it's human or otherwise, if a resource is scarce, the prices go up. And we are seeing prices moving now in some areas, and less resistance to those prices in recent months. This isn't an explosion of World War II scarcity or anything like that. But it's definitely going that direction, Becky.
And then you wonder where that gets us in terms of inflation that the Fed would start to see and potentially act against. And there's so many people who are trying to figure that out.
And I see all these figures, and I don't change one thing I ever do in terms of buying. I've never changed an activity based on a headline in my life that I can remember, or an editorial opinion, or even the facts we get. I'm aware of them, and I like to know them. But it's going to be a different news a year. We're going to own the company a year from now or 5 years from now. But I can tell you, I mean, if you're a policy setter, if I was a member of the Fed board, I would be, I've got a responsibility then in terms of these figures, and I'm trying to steer them to some degree.
But it may not have affected or impacted the decision on whether or not you were going to buy a business, but it does impact your valuation expectations in terms of looking at stocks versus bonds or stocks versus something else. You've told us on this program that inflation acts as a weight on stock valuations, and when interest rates are so low,
it should push up interest rates
right.
over time, and it's very easy to talk about having a 2% goal, but it's another thing to keep it from going. Once it starts in either direction, we don't know how well that'll work.
Let's talk about something that Joe alluded to earlier, and that's China and trade, not just with China, with Mexico, with NAFTA, other things that are happening. But our delegation just returned from China over this weekend. This is Stephen Mnuchin, the Treasury Secretary, Wilbur Ross, Lighthizer, all of them coming back. And now we have to wait and see. We have to figure out if Trump's tough talk will start paying dividends and improved trade relations, or if it pushes us the other direction and leads us potentially into a trade war. What do you think happens? By the way, here's a tweet from the president. I believe this was Friday night. Our high-level delegation is on the way back from China, where they had long meetings with Chinese leaders and business representatives. We will be meeting tomorrow to determine the results, but it's hard for China in that they have become very spoiled with U.S. trade wins.
Yeah, well, the answer is I don't think we will have trade wars because of significance. We will have trade movements, but in terms of the old-fashioned thought of a trade war where you just keep piling it on, I don't think that happens. It's counter to the interests of us. It's counter to the interests of China. It's counter to the interests of every country in the world. I mean, the world thrives on trade. We would not have the economy, nor would China, nor would the rest of the world have the economic well-being that they have without a lot of trade. And incidentally, in 1970, we exported and imported exactly the same amount. It was about 5% of GDP. So our exports have grown to 11% of GDP, which is a huge number now. I mean, but the imports there's about a 3-point gap or thereabouts. And there will always be people trying to get edges and all of that sort of thing. But in the end, China and the United States have a common interest in something very big, and then we have a less than common interest in some things around the edge. The world will not do something stupid over time in trade.